Every great business story starts with a bold decision. The decision to step out, take control, and build something of your own. Entrepreneurs are not made in comfort zones. They are made in moments of courage, moments when you decide to move forward, lead, and grow. Welcome to ISFA, Indian Small Business and Franchise Association, the driving force behind India's thriving small business and franchise community. Since 2008, we have stood alongside India's MSMEs, enabling ideas to become enterprises and entrepreneurs to become leaders. Today, over 6.3 million MSMEs in India are growing, learning, and expanding with ISFA. With 1,200 plus live events every year and more than 1,500 industry enablers as partners, ISFA is a dynamic network of opportunity. We're shaping India's franchise future with fairness, transparency, and trust. At ISFA, we connect ambitious entrepreneurs to top global and Indian franchise brands. Whether you're starting out or scaling up, ISFA gives you the platform to grow. With funding support, skill building programs, and international trade access, we help you unlock your potential. Small businesses don't stay small for long with ISFA. They become tomorrow's success stories. So, take the leap. Join ISFA today. Let's build the future of entrepreneurship together.
Good afternoon, everyone. On behalf of the Indian Small Business and Franchise Association ISFA, I extend a warm welcome to all our participants, industry professionals, tax practitioners, finance leaders, and business owners joining us today for this insightful webinar on recent trends in GST litigation. The GST landscape continue to evolve rapidly with new judicial interpretation, regulatory development, and compliance changes, shaping the way businesses operate. Staying updated on these changes is essential for organizations to effectively manage risk and ensure compliances. We are privileged to have with us two distinguished experts, Mr. Vaibhav Jaju and Mr. Somil Bhansali from Durva Advisors, who bring extensive experience and deep expertise in indirect taxation and GST matters. During today's session, they will share valuable insight on recent development in GST litigation, landmark ruling and their business implications, emerging trend in GST dispute, and practical insight for tax and financial professionals. I am confident that this session will provide actionable knowledge and help participants better understanding the evolving GST litigation environment. Thank you all for joining us. I encourage everyone to actively participate and make the most of this opportunity by sharing your questions in Q&A box, and we will answer all the questions after the presentation at the end of the session. Now, without any further delay, I would like to invite our esteemed speakers, Mr. Vaibhav Jaju and Mr. Somil Bhansali, to bring today's session. Sir, over to you, Vaibhav ji.
Thank you, Akshat ji. So, good afternoon, everyone. It is a privilege to be speaking before members of ISFA, and such a distinguished gathering of entrepreneurs, business owners, franchise operators, and professionals. To start with, I often say that GST has become like electricity. You only notice when there is a problem. When everything works, nobody talks about GST. But when a notice arrives, an ITC gets blocked, or a demand is raised, suddenly GST becomes the most discussed subject in the boardroom. Regarding today's discussion, my endeavor is not to discuss law for the sake of law. My endeavor is to discuss what this development means to your business, your cash flow, and your future dispute. Regarding the first topic, GST Appellate Tribunal developments, to understand how does it impacts a business or a franchise owner, let's start with a simple question. Why does a tribunal matter to a business or a franchise owner? Because until now, if you are disregard with a GST order, your options were either limited or complicated, and often you had to approach the high court, which is like going to a multi-speciality hospital for a common cold. So what were the problems so far? Since GST started in 2017, tribunal was not functional, appeals got stuck, high courts were flooded. For businesses, this meant delayed in justice, higher legal costs, and cash stuck in pre-deposits or demand. And now what has changed once GST has operationalized? So there are a number of benches which will be functioning across the country. Ideally, I say ideally, decision will be faster, more practical, more consistent. And what does this mean for you? This is very important. This I have tried to translate into business impact of 4 areas. First is faster dispute resolution, hopefully. Instead of waiting years in High Court, you will have a dedicated forum. But a small caution over here. In India, faster than before doesn't always mean fast. Second, more cases will go to appeal. Earlier, many businesses avoided litigation. Now, tribunal becomes a more accessible option. Expect increase in litigation volumes. This we can quickly glance through the statistics table which we have. So if you look at, this is the litigation pendency under the erstwhile regime as well as GST. And for the erstwhile regime, we have taken the data from Business Standard Rajya Sabha, where Rajya Sabha data was quoted by Business Standard. The data pertains to year back, which is March 2025. The pendency before CSTAT is more than 55,000 cases, before High Court is more than 24,000 cases, and before Supreme Court is more than 2,500 cases. And interestingly, a report which was done by Times of India at the time of GST launch portal in December 2024, it was estimated that 4,83,000 appeals will be filed. So if you look at that, the total litigation which remains under indirect tax domain is roughly around 5,60,000 cases. Out of that, 85% will be stuck, blocked, or resolved at a GSTAT level. Coming to today's statistics of GSTAT, if I say as on today, what is being filed and what is being registered. So total registered user on GSTAT portal are 30,000 plus, where advocates and professionals constitute around 9,500. Total appeals filed till date today are roughly 13,000, and appeals filed in the month, this month itself is 1128. And I hope that this figure is increasing day by day, as typically we have a tendency that we do the compliance at the last moment. So shall we do this time also, and this filing will substantially increase. Third aspect of this is cash flow, in fact, because there is a pre-deposit. To file an appeal, you effectively need to make a 20% pre-deposit, 10% at a first appellate authority level and 10% at a GSTAT level. For businesses, this is crucial, especially for small businesses. So plan disputes like you plan your capex, because litigation now requires investment. Fourth aspect to this is documentation will become crucial. Tribunal will focus heavily on facts because it is the final fact-finding authority. So your agreements, invoices, vendor records, and internal control, this all must be strong. In GST litigation, your paperwork wins the case before lawyer does. And some practical tips for our members, if I have to give, there are three simple takeaways for this. First, keep your records clean and accessible. Second, respond to notice timely. Missing deadline to file before GSTAT could be fatal. Third, Don't ignore small dispute, they grow fast. Regarding the timelines, so currently for any order which you want to file a appeal, any order which is issued up till 31st of March 2026, the deadline is 30th June 2026. Further, regarding the filing procedures, if you look, they are more in line which is adopted for a high court with the online filing. The procedures are stringent. However, there was an extended deadline where the procedures and court clerk procedures and verification will be followed on a leniency basis till 30th June 2026. That stands now extended to 31st December 2026. And with the discussions with the authorities and GST officials, what we understand is currently they are focusing that appeal should be filed in a timely manner with the limited requirement where there is a wakalatnama, a properly signed affidavit with your facts, grounds, and relevant annexures. So rest of the requirement for the time being are kept on a leniency basis. To summarize, GST tribunal will make disputes easier to fight, but also harder to win without proper preparation. So what are the immediate action points? I would say 3 immediate action points. First, review your existing disputes and identify which ones are suitable for GSTAT. Your factual dispute, valuation issues, classification matters are all natural candidates. Second, assess your exposure in pending writ petitions. If a statutory appeal remedy now exists, your writ may be at risk of getting dismissed. Recently I faced this in Bombay High Court, where I was directed to file the appeal before GSTAT as alternative remedy now exists. Then came a technical question before me. Just a minute. Hello. Yeah, sorry. Then came a technical question before me that, once the High Court has directed me that now there is an alternative remedy and I need to file a appeal before GSTAT, the next question which came to me was, do I require to pay a pre-deposit where I have to file a appeal before GSTAT? The reason being, I'm filing this appeal now before GSTAT because this is an order or a direction by the High Court. So basis this order of the High Court, I am going to GSTAT and not against an order of the first appellate authority, that is Commissioner Appeal. And to this, the judges simply responded by asking me a simple counter question. What would you have done if the GSTAT was operational? And the answer was simple. I would have gone to GSTAT, not the writ jurisdiction, the alternative remedy, and I would have paid the pre-deposit. So this has to be kept in mind. Third, revisit your litigation strategy, particularly for high value disputes, because the stakes at GSTATs are significant. With this, let me now move to our second topic, what I believe are the most important litigation themes for businesses. The first theme in today's world is input tax credit. If GST litigation had a king, I would undoubtedly be input tax credit. Almost every business today has some ITC issues, be it block credit, supply didn't file returns, mismatch between your data and GST portal, vendor turns out to be non-compliant, and suddenly your ITC is questioned or denied. The irony is interesting. Businesses believe GST is designed to avoid cascading of taxes. Revenue authorities often focus on ensuring strict compliance. Most litigation arises in the space between these two objectives. My simple practical suggestion to businesses: first, do vendor checks. Rather spend as much time selecting vendors as you spend selecting your customers. Because under GST, sometimes your vendor's mistakes becomes your litigation. Second, avoid dealing with unknown suppliers purely for cost saving. Third, reconcile ITC regularly. Think of ITC like cash in your bank, protect it. We will further discuss on this theme of ITC dispute when I will share some incidences and the relevant judicial precedents. Theme 2 is the classification issues. This directly impacts your pricing. For example, is your product taxable at 5, 12 or 18? Whether it qualifies as goods or service, even today dispute continues on these aspects. The simple truth is GST simplified taxes but not classification arguments. So here my advice is don't take aggressive position without support. If classification is unclear, document your reasoning. Third, procedural errors. Very common for MSMEs, SMEs and MSMEs. Many disputes are not about tax but about mistake, late filing, wrong entries, missed timelines, refund filing errors. Small compliances mistakes often create big tax disputes. So the simple takeaway is invest in process and training. Review your filings periodically. Fourth litigation theme nowadays is investigation and notices. There is a clear trend where more audits, more notices, more aggressive questioning, even for genuine businesses. Data analytics and investigations is playing a pivotal role today. The GST officer may know about a discrepancy before the taxpayer notices it. GST administration is increasingly driven by data analytics. Your returns, your e-way bills, your e-invoices, financial statements, third-party information, everything talks to everything else. In earlier years, audit examined documents. Today, algorithm examines patterns. Business, therefore, need to be focused on data consistency. Major disputes originate from a system mismatch rather than a physical inspection. So my advice is, first, don't ignore notices. The most expensive GST strategy is often silence. Second, don't respond casually. A well-drafted reply at the show cause notice stage can save years of litigation. Therefore, I always say, how you handle a GST notice in the first 10 days often decide the next 2 years. Third, take professional help early. As I have seen businesses spend lakhs of rupees on appeals to fix issues that could have been addressed through detailed response at the first instance itself. Fifth is franchise specific risk area. I think this is more relevant to ISFA. Let me highlight you a couple of relevant instances. So regarding say franchise fee or your royalty, there are taxability dispute, whether it constitutes a supply or not. What is the valuation if it constitutes a supply? Marketing support and cross charge. How to value, whether taxable, again the area of taxability, non-taxability. Mixed supply issues, where combos are offered or bundled services are given. How the agreements or the documents are, how the facts are, how the invoices, how I am marketing my product. This all plays an important role. I would like to share an example specifically which I faced, which was for a franchise business. A franchisor had, modified its commercial model over time. As and when this evolved, it grew. Additional support services were introduced. Technology support expanded. Marketing contributions evolved. New charges were added. Everything made commercial sense. Perfect commercial decisions going good. But the franchise agreement had not kept pace with business reality. Several years later, question arose regarding the nature of supplies, documentation, and contractual allocation of obligations. So legal position, without getting technical, I would say under GST, documentation and commercial reality must move together. When business models evolve but agreement remains unchanged, litigation risk increases. So the lesson is every time a business team changes a revenue stream, tax teams should ask one question. Do our documents still reflect what we are actually doing? So key takeaway, in many GST dispute, the problem is not what the business did. The problem is what the agreement forget to say. Again, two simple takeaways or advice for businesses. If the business model is evolving, the tax position should evolve alongside it. In franchise models, structure and documentation are as important as your pricing. Sixth theme, refund issues, especially for exporters, franchise models with inverted duty. Problem typically includes, which we all know, delays, rejection, documentation issues. The sad reality is getting refund under GST sometimes feels harder than paying tax. And last, I would say, is personal liability and governance. This is an area that promoters and senior management should closely watch. GSP disputes are increasingly intersecting with governance discussions. Directors, key personals, and senior management are given personal notices with penalty and prosecution. With this, I would move to our last topic for the day and most relevant to take the practical key aways is the recent rulings. Our first ruling is on the aspect, can an officer seize, detain, or confiscate interstate goods in transit? This ruling is by Andhra Pradesh High Court in the matter of golden traders. On a lighter note, we have promoters and business heads here, and I need not explain why on the field officers at checkposts are so vigilant. Coming back to our ruling, the facts were that the consignment were moving from one state to another, say typically Kerala or Karnataka to say Delhi or Maharashtra, where interception happened in Andhra Pradesh because it was a transiting state by the Andhra Pradesh GST authorities. In most cases, the consignments were accompanied by valid documentation. Detention and seizures were undertaken primarily on grounds of undervaluation, mismatch in quantity, or discrepancy in description. The matter went to High Court principally on two questions. First question was whether the state GST officer of a transit state is having jurisdiction under section 129, 130, that is seizure, detention, and confiscation powers under CGST and state GST in respect of interstate supplies. And second question was whether valuation related discrepancies can justify detention, confiscation under these provisions. So relying on Supreme Court rulings, the Andhra Pradesh High Court reaffirmed that cross empowerment under GST framework is not automatic and jurisdiction cannot be assumed in absence of statutory authorization. So there has to be an authorization. Where a supply originates outside Andhra Pradesh and culminates outside Andhra Pradesh, jurisdiction is fundamentally absent in absence of any revenue entitlement to the state. Because as you are aware, GST is destination-based consumption tax. So where the goods will be finally destined, that state gets the revenue. Further, it held that powers of seizure, detention, and confiscation are confined to cases involving clear incidents of tax evasion, such as absence of falsity of documents, forged e-bills, or complete mismatch of goods, and cannot be invoked to undertake assessment of valuation exercise at stage of transit. Basically, the takeaway is that seizure, detention, and confiscation is only applicable where you are doing a tax evasion or where the documents are forged. You cannot do any type of assessment under that guise. So practical takeaway from this ruling is that whenever you feel that the goods are wrongly seized or detained or confiscated by transiting state officer, the matter is worth taking to High Court on jurisdiction based on this ruling of golden traders. Documentation hygiene is your first shield. So if you have all the documents are in line and proper with corresponding details, your e-way bill, invoice, delivery challan, description, then I think detention without document fault is indefeasible. Value disputed at check post, if that be the case, demand for a proper assessment, for a referral to a proper assessment. And most importantly, you should brief your logistics and compliance team this ruling because it substantially reduces arbitrary detention risk. Next ruling which I want to refer to is the celebrated ruling of Safari Retreat. So this ruling has become law of the land today. This was delivered by Supreme Court. A review petition was filed before Supreme Court and it was dismissed, and therefore this is the law of the land. And I am emphasizing it because this ruling, I think we need to read holistically, and where there is a little bit gap in that holistic reading. So coming to the facts, Safari Retreat constructed a shopping mall for letting out premises to tenants, and it accumulated crores of rupees of ITC of GST paid on steel, cement, lift, AC plant, professional services, and other constructional input. The matter went to High Court. High Court provided a purposive interpretation of the word on own account. It allowed the ITC. Then the department went to Supreme Court, where the matter was argued before the Supreme Court, and Supreme Court interpreted that the term plant or machinery used under section 17(5)(d) is different from plant and machinery, and therefore a functional test need to be applied, and if it qualifies as plant or machinery, credit may be allowed and the matters stand remanded. While we know this part of the story, the important aspect remains under para 32 of the ruling. So if you refer para 32, it clearly says that for eligibility of credit under section 17(5)(d), which is goods or services used for construction of immovable property other than plant and machinery, because if it qualifies as plant and machinery, you are eligible to credit. There are two exceptions. And the second exception is very important, where it says that first exception, when it qualifies as plant or machinery, which now stands amended as plant and machinery. The second exception is where goods or services or both are received by a taxable person for construction of an immovable property made not on his own account. So if you create something which is not on your own account, then the ITC is still eligible. And it clearly says, if you refer the last line of the para, construction cannot be said to be on taxable person's own account if it is intended to be sold or given on lease or license. So today, if you construct anything which is given on lease or license, the ITC is available, be it for construction, cement, steel, and anything. Now it has given what would mean that it is not on own account. So they have given in a negative way. I'm phrasing it as a positive way. If something which is constructed is not used for personal purposes and it is used for provision of service, this is first, I would say, a compliance or a precondition. And second, the person should use it for as a means to its business and not setting to a business. This statement I will explain through an example. So if there is a factory building, the building will be typically treated as setting to a business because it's a setup which you do a business. However, the machinery will be considered as means to a business because finally the product is manufactured from this machinery. So if you are able to prove that, then you are eligible to credit. And this ruling is very important because keeping in mind the principles put by the Supreme Court and keeping in mind your business structure, if you try to structure the construction activities properly, then in that case your entire ITC is legally eligible. So that tweaking or structuring for ITC is the key which I wanted to share with you. The next ruling that pertains to ITC dispute. And if you remember in the earlier discussion, I said that I will share an incident which I faced couple of times and to understand this judicial precedent. So one of the incidents is about a growing retail chain and it had everything in order. Goods were received, invoices were available, payments had been made, finance team satisfied, statutory auditor satisfied, management satisfied. But then GST authorities conducted an investigation. The issue was not with the recipient. The issue was with few suppliers who had defaulted in tax compliance. And suddenly the business found itself defending substantial ITC claims. What struck me was that the dispute was not really about GST, it was actually about vendor governance, as we discussed. The business had spent enormous time evaluating commercial capability of suppliers, but very little time evaluating that compliance capability of suppliers. So legal position, if I have to say today, eligibility to ITC is linked to fulfillment of statutory conditions under Section 16 of the GST Act. The jurisprudence continues to evolve on the extent to which a bona fide recipient can be denied credit because of supplier level failure. Different factual situations are producing different outcomes. However, one lesson is clear. Vendor due diligence is no longer merely a procurement function. It has become a risk management function as well. In GST era, sometimes your biggest task risk is not your compliance. It is somebody else's non-compliance or compliance. So similar situation arose before Gujarat High Court in the matter of Maruti Enterprise, wherein the supplier had not deposited tax with the government, and therefore the appellant's ITC was disputed under Section 16, subsection 2, clause E. The appellant approached Gujarat High Court to either struck down Section 16, subsection 2, clause C as unconstitutional, or at the very least, read it down to protect bona fide purchaser who had no fraud or connivance. A perfectly reasonable ask in my view. The Gujarat High Court said no, and it gave clear 5 reasons. The first reason was that ITC is a statutory concession, not a vested right. The legislature can impose conditions, and those conditions must be strictly satisfied. Second, the burden under Section 155 lies squarely on the purchaser to establish that the supplier had paid the tax. Third, reading it down would force states to transfer revenue they never received, making GST unworkable as a system. Fourth, they referred to Rule 37A and provide that it is not that the buyer at the default of supplier is remediless. According to them, there is a time limit which is given where under Rule 37A, by next 30th November of the financial year, you evaluate, and if the supplier has not paid, you reverse the credit, and your right to take the credit remains when the supplier pays the tax. And fifth, and this is more important, the High Court remarked that the purchaser is not entirely without remedy. They can pursue an indemnity clause in the supply agreement, and the government can recover from the defaulting supplier. Now here where it gets interesting, where Gujarat stands alone in this position. While other high courts, if you look at the screen, where Tripura, Himachal Pradesh, Guwahati and Delhi High Court have given a favorable ruling, Gujarat High Court is only the ruling which is against by putting this law of the land. And even though there are Supreme Court rulings, though from a VAT perspective, on the same principle, the Gujarat High Court distinguished the VAT rulings by saying there is a difference between GST and VAT. While typically VAT, the revenue is to the originating state or the selling state, under GST, it's a destination-based consumption tax, and therefore this principle cannot be applied. So what do you do right now? So I would say 3 things. First, insert supplier indemnity clause in every purchase agreement. The Gujarat High Court itself has endorsed this. It shifts the financial risk back to where it belongs, with the defaulting supplier. 2, monitor GSTR to be monthly and reverse ITC proactively under Rule 37A by 30th November following the year of availment. This avoids interest liability, which compounds the pain significantly. 3, know your jurisdiction. If you are in Gujarat and your supplier defaults, your only route today is Supreme Court. Outside Gujarat, you can refer to the other favorable High Court ruling, the latest being Karnataka High Court in case of Instacart, which is tax friendly and that can be used. The Gujarat High Court has reminded us that compliance is a chain, and the chain is only as strong as the weakest supplier. Until the Supreme Court gives a definitive answer, this remains one of the most live and consequential issues in indirect tax today. Next ruling, I am taking the issue of consolidation of show cause notice, the core problem. And this affects to anyone who has received a show cause notice that bundles multiple financial years into a single document. The practice is common. Revenue issues have one SCN spanning, say, from 18-19 to 22-23, 4-5 years clubbed together instead of separate year-wise notices. Why this is a problem? There are for two reasons. First is limitation. So if you refer section 73 and 74, the limitation for passing an order runs independently for each financial year. But when you club the years together, you sort of try to distort that. A time-bound year gets carried along with a consolidated notice and the taxpayer loses year-specific litigation defense. Second, the pro-consolidation arguments which revenue relies, they refer to section 73 and 74 and typically to the wordings where the phrase used under the section are for any period or such periods. And revenue says that this shows that the legislature never intended an annual restriction. That argument has traction in some court, which exactly why this issue is. Now, if I come to the factual metrics, if you look at the screen on your table on left hand side, which is green, that green is for revenue, where the High Court, these High Courts have consistently held that consolidation can be done. So they are saying that's legally right and can be done, subject to yes, that the time bearing aspect must be excluded. So that they have said. Coming to the right side of the screen, these are the rulings which are in favor of the SSC, where it says that consolidation needs to be struck down. Now, in all this hodgepodge, if I have to give a situation, Bombay High Court has referred this matter to a 3-member larger bench, and therefore the decision is awaited for jurisdiction of Maharashtra from there. And recently, as good as in, I would say last week, in case of Brilliant Metals Limited, the Supreme Court has sort of tried to club the matters and they will be hearing, and therefore the law will evolve at Supreme Court. Interestingly, recently at Gujarat High Court in Javandamal and Dharnamal case, the ASG has made a remark before the government, and this is a piece of nice information for us. It says that the GST authorities are trying to resolve this by making suitable amendment to the text of the legislation, and this will be taken up with the council. So this is something interesting, and therefore what we should do today, regardless of which high court you are sitting, always raise your limitation ground year by year in your reply. Even if the consolidated notice survive, time-bound years must be excluded. Second, of course, watch out for the outcome of Supreme Court ruling. With this, I would now like to invite my co-speaker, Somil Bansali, to take this ahead. Over to you, Somil.
Thank you, Vaibhav, for your insights. Now, let's talk about something that hurts the most, your working capital.
Somil, you are on mute.
Sorry. So thank you, Vaibhav, for your insights. Now, let's talk about something that hurts the most, your working capital. As already discussed, while filing an appeal before a GSTAT, there is a pre-deposit requirement. Similarly, when you file appeal before the first appeal authority, you are required to pay the pre-deposit. So here the question is simple. can that pre-deposit be made from your electronic credit ledger, or it must flow from the electronic cash ledger, meaning the hard cash? This question is important because it will impact your working capital. Practically, there have been instances where the authority has asked the taxpayer to pay the pre-deposit from the electronic cash ledger. So before we move to the court rulings, let us discuss the CBIC position on this issue. So CBIC in Circular 172 refers to Section 49(4) of the CGST Act. As per that section, electronic credit ledger can be used towards payment of output tax. So the GST law has defined the term output tax, and as per the said definition, output tax means tax chargeable on taxable supply of goods and services. So basis this, the circular has clarified that any payment towards output tax, whether that payment is through your GST return or it is arising out of any proceeding under the GST law, the balance available in the credit ledger can be used. So the logic used by the CBIC circular is straightforward. Pre-deposit is nothing but the payment of tax. So it will fall within the definition of output tax, and thus the balance in the credit ledger can be used. I would also like to refer notification 53 by 2023 central tax, wherein the procedure was notified for delayed filing of appeal before the first appellate authority. In that procedure which are notified, there was a requirement to pay pre-deposit of 12.5%. So the notification specified that 12 out of that 12.5%, 20% of that amount should be from the electronic cash ledger. So in other words, the balance amount can be paid from the electronic credit ledger. So this notification is nothing but the implicit acknowledgement of the position, which is the pre-deposit can be made from the electronic credit ledger. Now coming to the High Court rulings which are issued on this matter. So there are 5 High Courts who have issued a favorable ruling, which means the High Court has stated that the balance available in the electronic credit ledger can be used to make the pre-deposit payment. So these High Courts are Madras, Karnataka, Bombay, Allahabad and Gujarat High Court. But the interesting point is the ruling of the Gujarat High Court in Yasho Industries was challenged by the revenue before the Supreme Court. But the Supreme Court dismissed the SLP. But here the important point to note is that SLP dismissal is not the endorsement of the Gujarat High Court order. Though today the Gujarat High Court order stands, but it does not become the Supreme Court law. The reason why this discussion is important because there is a conflicting ruling of the Patna High Court on this matter. As per that ruling, the amount of pre-deposit must be paid from the cash ledger. Interestingly, the Patna High Court position is being tested at the Supreme Court in Flipkart Internet Private Limited, which is yet to be decided. So with this background, now the question is, what is the way forward? So first, if you are in a jurisdiction other than Patna, the position is clear and strong. Use this circular and favorable High Court ruling if officer rejects the pre-deposit payment using the credit ledger. But if you are in a Patna jurisdiction, it is advisable to pay the pre-deposit in cash. However, one may rely on the circular 172 issued by the CBIC, but it will not be free from litigation. And lastly, interest, penalty, late fee and RCM liability are to be paid from the electronic cash ledger because it does not tantamount to output tax. The circular and the favorable High Court ruling does not change this position. Now, having understood the litigation around pre-deposit, let's address the one of the most important amendment in the GST landscape this year, that is the taxability of intermediary services. So till 29 March 2026, Section 13(8)(b) of the IGST Act provided that the place of supply in case of an intermediary services would be the location of supplier of services. So as a result of this provision, even when the services were provided by an intermediary located in India to a foreign client, the transaction was deemed to be taking place in India and GST became payable. So now just think of the anomaly that this provision had created. Foreign currency was coming into India, the recipient was outside India, and thirdly, the services were consumed outside India. So in other words, almost all aspects of the export transaction were present. However, still the transaction was not given the export benefit because the place of supply was deemed to be in India. As we know, to qualify any transaction as export, the place of supply should be outside India. So not surprisingly, the provision of Section 13(8)(b) of the IGST Act was among one of the most heavily litigated provision under the GST law. But the good part is that era is over now. The provision of Section 13(8)(b) is omitted with effect from 30th March 2026. As a result, now the place of supply of intermediary services defaults to Section 13(2) of the IGST Act, which is the location of supplier of services. So for Indian suppliers supplying intermediary services to a foreign client, the transaction will qualify as export of services. Reason being, all the conditions of export of services are being fulfilled, including the place of supply condition. Conversely, the Indian recipient receiving services from a foreign intermediary will now classify as import of services, and then tax is required to be paid under reverse charge mechanism. In this amendment, due to this amendment, we should note one important thing. This omission of Section 13(8)(b) of the IGST Act was made without a saving clause. So in such a case, legally a view can be taken that all the pending disputes where the department has alleged intermediary services to raise any demand or to reject any refund claim should be dropped. However, practically speaking, this view will be aggressively contested by the department. Now, having understood the amendment, the immediate question is how do we deal with the transactions that were underway as on 30th March 2026? So as per my understanding, in this case, the critical factor is not the invoice date, but the date on which the underlying supply was being made. The invoice date will help us to determine the time of supply and when tax becomes payable. But in the present case, the issue is of levy of tax. So to understand this better, I refer to the ruling of Honorable Supreme Court in Wazir Sultan issued under the excise regime. So the court made a clear distinction between the taxable event and the machinery provision of assessment and collection of tax. So in excise regime, the taxable event was manufacture of goods, whereas the point of collection of tax was removal of such goods from the factory. So the same logic applies under GST. In GST, the taxable event is supply, and when the tax is payable is precisely given under the time of supply provision. So to summarize, the taxable event creates the liability, whereas the machinery provision help us to determine when such a liability is to be paid. So applying the principle laid down by the Honorable Supreme Court, if intermediary services are provided after 30th March 2026, then argument can be taken that amended provision will apply, irrespective that whether the invoice was raised either before the amendment or after the amendment. And conversely, where the services were completed before 30th March 2026, the erstwhile provision will apply, notwithstanding the subsequent invoicing. So if you see the table on the screen are prepared basis the principle laid down by the Honorable Supreme Court in Wazir Sultan. But one important thing to note is if such view is adopted, then I would request each and everyone to maintain a robust documentation, as I suspect substantial litigation around these transitional transactions. So in short, the amendment has resolved the long-standing controversy for the future, but the transition period is likely to generate fresh litigation for the future years. So with that, we open the floor for Q&A.
Just a minute, Somil.
Hmm.
Just adding to Somil's point.
Hmm.
So with this change on intermediary, one of the key takeaway is as you would understand that from 1st April, the taxability has changed. What earlier remains taxable may be exempt and vice versa. And therefore, as a business, what can be done is we can try to reevaluate the position and see if, contractually the return orders, the contracts, if a changes can be made and we can comply with the law to be exempt or continue to be exempt. So that is a key in this that businesses need to take care. Yeah, so we can go ahead with the Q&A now.
So in Q&A, we have 4 questions. I'm sure you are able to see Vaibhavji and Somil. Should I read out or you are able
I
to
could
see?
track only one question.
In Q&A box, there is a separate Q&A box in the bottom. If you go with the more option, there is a Q&A box.
Okay. So the first question is from Ms. Chandrika Chaudhary. It says that if SCN has been become time barred, should we still entertain queries for that year by GST authorities? So here you need, according to me, you need to, but then you need to only give, not in detail, I would say just the tip of the iceberg. And reason being, so tomorrow you are not alleged of a non-cooperation. That is first. And when you reply, you clearly reply that the SCN has become time barred under 73-74. However, being a law-abiding citizen, I am giving you the replies to your queries and reply it in a manner that it doesn't hinge you or doesn't comes against you. This is for the limited purpose, as I told you, that your department doesn't allege a non-cooperation on you. That is one. And secondly, if still a SCN is issued, though time bar, you have very good grounds on jurisdiction and merits ground both. So I think this approach you should follow. The next question is, the officer mistakenly attached pre-SCN questionnaire instead of SCN. What happens to such assessment? No, so I think when you are using the word assessment, you mean to say that a SCN is issued to you, but instead of SCN, a pre-SCN questionnaire is being attached and not the SCN. So I think the ideal approach in this case would be that since it's a portal driven this thing, you simply reply over the portal saying that, I am not able to view the SCN. What has been provided me to is a questionnaire. By putting this 2 lines and you stop over there and then wait what the next step is done by the officer. Next question is by Hemant Thakkar. Expire e-way bill and not uploaded during transit and issue expired e-way bill and not updated during transit and notice issue under 129. Now, as I mentioned, your documentation compliance is important. So if e-way bill is expired, then as per the procedure, you need to revive it or regenerate it, but you have not followed that. So better way would be to contest basis your other documents proving the genuinity that the transaction is right, whatever was disclosed in the invoice and the e-way bill matches, consignor consignee place, valuation, description of goods, there is a transporter appointed, and if you can substantiate through the toll plaza receipts and the way bill receipt. So you just need to substantiate your bona fide, and there is a Supreme Court ruling which has affirmed that. I'm missing the name. Is testing of sample in India which qualifies for export, but because sample is made available, will it be is testing of sample in India which qualifies as export, but because sample is made available, will it be? Chandrika, here I need to know the facts, the testing, if available, whether it is destroyed or sold or sent back. This is very factual, and I think there is a clear rule given to that, clear sections and rule. So accordingly, it can be answered, but too factual, maybe we can connect separately. Destructive and send back both. So then it's your question is which India which qualifies for So your question is what is the place of supply of service? So according to me, the place of supply of service will be export and it will be treated as export. We took warehouse on rent, Bhakti Raja's Quarry. We spent lakhs for electrical works contract to convert it into as per customer's requirement. We provide 3PL and warehousing services to customers. Can we take on this? Yes, you can take on this contract, on this expense, subject to we need to understand what is the purchase order or work order you had given, under which classification the invoicing is done, and most importantly, the principle over here is if I'm able to prove that warehouse is I'm providing and rent, and as per Safari Retreat judgment para 32, whatever I do to a warehouse I'm eligible to credit, because ultimately it's a means to my business on not setting up the through warehouse I am providing output service. So very well the credit should be available subject to review of your factual documentation. Akshatji, I think that Q&A is being done. This is the rejoinder which I explained.
Yeah, we have one question in chat box, which
The
is
Supreme Court issues notice on constitution.
this is we are constructing IT park and later on we will lease out it. So can we adjust that ITC against GST arise due to the lease rent? In chat box we have
Abhijit, that is what I discussed. But as I mentioned, Safari Retreat is there, but there are too many things and exercise needs to be done. Your input contract, your output contract, and the credit is eligible. Safari Retreat is law of the land. Even the review petition is dismissed and the credit can be taken. It para 32 clearly says that anything which is done for a leasing or licensing, that is not on own account.
in Q&A box. There is one question from Miss Payal Sharma.
I don't know, it's a question or it's a info. So Somil, this is on 16.2c, which we were discussing the Gujarat High Court matter. So Gujarat High Court in Maruti Enterprises is the against ruling less all favorable ruling. So
Yeah.
I don't know what they want to say about Supreme Court. Somil, can you just help with this?
So yes, this question is not clear because we
Yeah,
had referred to the ruling of Gujarat High Court and rest all were favorable.
yeah.
Okay. So as we are at the end of our session, thank you very much to both our experts for sharing their insight and valuable knowledge with our participants. And I just want to update to all participants, we will share the presentation of the session with you and also share the email ID of our experts so that you can directly reach out to them post webinar for your queries, and you can also avail their services professionally as well in your company, in your businesses. Because Dhruva Advisor is no need to any introduction required for the Dhruva Advisor. They are the well-known law firms and trusted firm of India, and they are not only in India, in international market also, as I see in on his slide that Abu Dhabi, Dubai, Saudi, Singapore, they are also established here. So thank you very much for this session, sir. And our our next session is on 9th of June, which is a knowledge session for how to invest in the right franchisee. So see you on 9th, and we also plan our next session with Dhruva as well, and we will update you soon about the next session details. Thank you very much, everyone.
Thank you, Akshatji and team. Thank you. Our
Thank you,
pleasure.
Akshay.